Okay, I'm working through the study guide, so make sure you're out there working with me on page 3 of the study guide. So the units of production, we have kind of the same thing that we were doing a minute ago. We got our original cost. So we'll put 24,000 minus our residual value or salvage value. Again, we're going to use 2,000 there. So that's our same depreciable base of 22,000. Now, instead of dividing by the useful life, what we're going to do is divide by the estimated units to be produced. So if we have an equipment that is used hourly, this might be hours. If it's something that produces a product, we might determine that the product is what we need to use as an estimate, the number of products produced. So in the example here, I gave you the hours that were used of the equipment. So the estimated units to be produced, this is something that you're going to determine at the beginning of the equipment. So we determined that instead of 5 years, we're going to have 10,000 hours that are going to be used of equipment. So take the depreciable base, divided by the hours to be used, that gets us 220. What is this amount here? Well, this is the depreciation that we're going to be charging for every hour that is used during the year. So in 2010, we're going to track the hours that are used, multiply by 220. So in the example I gave you, 2,100 hours were used in the 2010 year. So what is that amount? 4,620. 4,620. So the idea here is that this does a better job of matching. The equipment is going to be used up more quickly the more we produce. If we only produced 100 units, then it's going to be used up less quickly and decline in value more slowly. So we're trying to match up revenue and expenses. This is a different way to do that. So figure out what the amount per unit, whether it's hours or units produced, and then you're going to have the example would give you in 2010, 11, 12, whatever years you're expected to calculate the depreciation. It would tell you how many hours or units were actually used or produced in that period. Okay, so that is an example of units of production method. The next one is probably the most trickiest. That's the declining balance method. Okay, and what this says is assets decline most in their initial years of use. So if you drive a car off the lot, the first year you might buy a car for $20,000. Well, what are you going to be able to sell that car for in the second year? Well, you're not going to be able to sell it for anything close to 20. You might be able to sell it for like 13,000. It might go down 7,000 in that first year. Now, what about the difference between year 4 and 5? Well, you might start out at a value of 6, but it might go down to 5 or something between those 2 years. So it declines more in value in the first couple years of asset life than it does in the later years. So we're trying to match up that decline by using this declining balance method. So what this does, working off this 5th page here, look at the book value at the start of the year. Okay, so we're not looking at the salvage value anymore. For the first part of this, we're going to ignore it. We'll get to how that comes into play later. But for the first part of the calculation, take the book value at the start of the year and you times the double the straight line rate. So what that means is, if we have a 5-year life, what does our 5-year life amount to as a percent? And when we did straight line, the straight line rate for a 5-year piece of equipment would be 20%. Okay, we're going to double that, double declining balance, DDB. So we take the 20% times 2, and we would get 40%. Okay, if it was a 10-year life, what would be our rate for straight line would be 10%. We would double it. It looks like 3, but that's really a 2. And we would get 20%. So that would be our double declining rate for a 10-year life. Well, in this example, we're doing a 5-year life, so we'll take the 40% here. Okay? So we take our book value at the start of the year. We ignore that 2,000 salvage value for now. So 24,000 times our double the straight line rate, the double declining balance, times 0.4. What do we get there? We get 9,600. Okay, so this is our depreciation expense for the first year. 9,600 would go there. See how much greater this is than the straight line and the units of production? So we had 4,000 in the first, 4,400 in the second. We've taken a lot more depreciation in the first year here. What would we do in the second year? Well, Look at our, remember this goes to accumulated depreciation, this is going to be a credit. So the difference in our book value now, the 24,000 minus the 9,600 is 14,400. Okay, in the second year, we do the same thing, except we start with the beginning of book value 14,400 times 0.4, and that amount is 5,760. So this would be our depreciation for the second year. We see we took a lot more in the first year, and then less in the second year. What would we do in the third year? We would take the 14,400 minus this amount. That would give us the new book value, times it by 0.4. We would have taken an even less amount in the third year. Now the key thing that you'll run into when you do this, remember our salvage value was $2,000. When you get to the final periods, year 4 or 5 of an asset life under declining balance, a lot of times if your salvage value is high at all, you're going to be asked to depreciate below that salvage value. So we might have a book value at the beginning of year 4 or 5, let's say is 2,800. Okay, when we did the 40% of that, we would have a number that's greater than, so what is that amount? That's 2,800 times 4. Let's go ahead and do that out. 0, 0, 2, 1, 1. So 1120 is that amount. Should we take, if this was our, I could work this problem all the way through, and there's examples in the book where they work it all through. But in this example, I'm just saying, at the start of the year 5, the book value is 2,800, and this is what our calculation tells us to do. Well, the problem is this would depreciate us below the 2,000 salvage value. So you got to make sure when you do the double declining balance method that you do not go below the 2,000 salvage. So what would we do here? Well, it tells us to do this, but essentially it is this or the difference between our book value and salvage value, whichever is less. So we would just do an 800 entry there rather than the full 1120, because we don't want to go below the salvage value. Make sure you understand that. There's an example in the books that help you on that part. So the final method, I don't know if this is really discussed in the book, but this is something that you definitely want to know. You'll see this a lot later on. Sum of the year's digits, SYD. Okay, and essentially this is a similar method to the double declining balance, except it's more, it's decreasing the amount that we take each year, but it's more, it's less severe than, I guess, the double declining balance is. So the calculation here are our initial value minus our residual value. So we have our depreciable base again. So 24,000 minus 2,000. So I guess this is 22. There's our depreciable base. And we times it by a rate each period. Now, how do we do the rate? Well, sum of the year's digits, we have 5 different periods for this asset life. So we're just going to add those up. 1, 2, 3, 4, 5. What is that total? 1, 2, 3, 4, 5. That totals 15. Okay? So the denominator in our calculation is going to be 15. And what we're going to do is we're going to decline the amount that we take each period. We're going to kind of go in reverse order. So in period 1, we're going to take 5 divided by 15. So we would take our 22,000 times 5/15. In that example, I have it on page 3. 7,333 would be our entry here. 7.333. Okay. What will we do in year 2, 3, 4, 5? Well, we got the same thing going on, but we're just going to go, so this would be year 2 would be 4/15. Year 3 would be 3/15. Year 4 would be 2/15. Year 5 would be 1/15. So in year 1, we took 5 times more depreciation than we did in year 5. All total, see, this is going to total 15 over 15th. We're going to take all 22,000 over the life of the asset, except we're just doing it in a declining way. So all this being said, these 4 methods are all estimates, ways to estimate what our entry here for depreciation expenses. And this is important because a lot of companies, their fixed assets are a big amount on the balance sheet, which means depreciation expense is a big amount on the balance on the income statement. So we want to have good estimates for these numbers there.